Welcome to tonight's live stream. As always, or I should not say as always, because we usually, at least for the past couple of months, have had the financial planners up here, but when we talk investments, we have the investment team. So Charles Scavone, Chris Paris. Guys, it's been, like I said, 3 months or so since we've been here.
Yeah, a couple months. We're going to get in one for the new year. That's great.
Yeah, it's been a while. I'm not sure what to even say. I don't remember the last time.
You got the first time jitters or nerves coming back up, Charles?
No, but it seems like we've been through a full market cycle since the last time we were here. So
I mean, you've already been doing these now with us for almost 3 years now.
I know.
Yeah.
It's hard to believe, but it seems like just yesterday, and then it seems like dog years sometimes. So,
well, this is one of my favorite times of year, not just for the holidays, not just for what's going on here at the company. We just had our Christmas party last week, and that was a blast. But we get to talk about what happened in the stock market and go back and we're not going to do too much of this tonight because, Chris, you every single year for the past 6-7 years, you put out a forecast, and it's an educated guess based on, what you think or where you think the market could go. This year, you said around 6660, I believe, in the S&P 500, around that range. We're at about 6,800 now, so not too far off. But the path to get to where we are today, as always, is unexpected. It's hard, impossible to predict the month-to-month ups and downs, some of the things that are going to come up throughout the year that could cause the market to go up or down. But we're going to focus on some of the defining themes for 2025. And one of those is going to be the AI boom, because we've had this massive expansion in the price of stocks directly in the AI, let's call it, industry, but then also tangentially related to the industry. And we'll get into those, as well as talk about some of the kind of the underlying themes that led to where we are right now. So just a couple of house cleaning items. I see some of the people who are always here with us. So Dwayne, good to see you. Do we have Fast Eddie or Drewski? Have they commented yet? Not yet, but I'm sure they'll be here soon. If you guys are here, love to hear from you. A couple of housekeeping rules here. So we're going to do a raffle tonight. We typically do 2 raffles, depending on how the conversation goes, how long you guys are sticking around. We may end up doing a third one at the end. So the first one will be in about 20-25 minutes. The second one will be towards the end. Let's call it about 50 minutes in. And to register for the raffle, you should see a QR code on your screen. You'll register. We're going to send you one of our guides, and the opportunity is to win a $100 gift card to your favorite restaurant. So we're going to do 2 of those tonight. If you'd like to register and participate, simply scan the QR code, go ahead and register, and our marketing team will be in contact with you if you win. Of course, we'll announce it here live on air. And the second thing, we want this to be interactive. So if you have questions, please, let's discuss them. Let's get them input into the chat box. We'll provide some surveys as the night goes along to get you guys thinking about your retirement, your investments. But any questions that you have, feel free to submit them. It helps us. It makes this more entertaining for you. And overall, it makes for a better show. So, Chris, I want to start with you. And I did just see Fast Eddie said hello. So we're here. I mean, glad you're here again.
We feel whole.
Yeah, we feel whole. They were asking about you before the show, so I'm glad you're here. Okay, Chris. So we can't start this show without starting at the beginning of the year. If we go all the way back to 2024, this time last year when we were doing the 2025 outlook, we talked about a couple of things. But the first thing that was on everyone's mind, and it just wasn't ours, it was that President Trump is most likely going to tackle tax cuts first and then get into some of the other items on the agenda, which would be tariffs and some of the trade agreements. President Trump completely flipped the script on us, and instead of starting with the things that benefit the market and then a lot of people were looking forward to, he came right out with the hammer. They came swinging. We had Liberation Day, so it was a bit of a rocky first quarter going into the second quarter. Let's just start there and cover that, get it out of the way.
For sure. Yeah, we thought we had a playbook. Donald Trump's second term, we thought, the first term, very pro-business, at least at the beginning. And we thought he would lead with tax cuts, pro-business, deregulation, the carrot. And he came out of the gate with the stick and promptly kind of beat us, and the market's down about 10%, I think, peak to trough. Going into April, the markets had kind of settled on a tariff plan of, I think it was around 15% was kind of baked into the markets. And then they came out in early April, maybe April 3rd, April 4th, with a spreadsheet no one had ever seen before and have no idea where the numbers came from, with tariffs anywhere between 75 and 150%. And the market went down 10% in 3 days.
3 days, yeah.
And peak to trough, minus 21%. Peak to trough, first quarter, which was hair-raising even for me with no hair.
That's good.
And unexpected. The good news is, we didn't change our outlook for the year. A lot of people kind of threw in the towel immediately, started cutting estimates, cutting their outlook. We kind of took a step back, took a deep breath, talked with Charles and the team, and kind of tried to let things settle out and see if things were going to be affected from an earnings standpoint. Because at the end of the day, over longer term periods, the stock market will follow earnings in the broad market. So.
And we kind of had this laid out as part of the playbook from the first Trump term, where we saw a little bit of President Trump using tariffs as a negotiation tactic, something to bring trade partners to the table and create this position of strength from which he would negotiate trade deals from. Now, some of that trade deal magic has worn off a little bit because there's such uncertainty in the U.S. political climate. One president comes in, we have trade deals, another president comes in 4 years later. So some of that maybe had worn off a little bit, and we still see some trade deals that haven't been completed. But Charles, you called it, so when they had the chart out there, it said Liberation Day. And then as soon as they showed that chart, I mean, you could immediately see the market's reaction. But you kind of called it a different, had a different
Liberation
term for it.
Day became Liquidation Day, and everybody liquidated their portfolios and just ran for cover, maximum uncertainty, sell first, ask questions later, and it just goes back to the fact that it's very important to have a forecast. But you have to understand that capital markets are very dynamic. They're not static, and so it just can't be followed step by step. And you have to hit, you'll have forks in the road, but you need to know where you're headed. You need to know where the roadmap is, and you need to be willing to pivot. And that's what we did. And we used Liquidation Day and the surrounding maximum uncertainty to, reorient how our portfolios were structured. Marginal positions that were at losses, they were sold. How might our outlook have changed? Okay, these are our new highest conviction secular growth names. Take the proceeds from those sales, reinvest them into those names, and be active, right? And try and be proactive in what we're doing, and that's what we did. And that's why it's also important, to have a disciplined, process-driven approach, right? Chris and I, what we would always tell you is sort of how do you operate in these sort of environments? And if you have a roadmap and a process-driven approach, it's what helps us navigate through all these types of periods.
And I think that's one of the big differences between, the average, let's say, retail investor or consumer versus, you guys combined with, 100 years of experience.
Yeah. Don't say it.
Yeah.
Don't say it.
There's some
But
sort of.
you guys have been doing this a long time. Both of you are working together prior to and even through the .com crash.
Yeah.
The visual that comes to mind when you mention that is you see the roadmap and you talk about the forecast. So you guys get together with James and Dwayne and the rest of the team, and you guys create, based on the information that you have at the end of the year, this is what we expect could happen based on the information that we have. This is our target based on all that information. But then variables are going to influence that roadmap throughout the course of the year, and that's what we saw with the tariffs. So Chris, kind of take us, when you mentioned it, you guys took a breather, you stepped back, and you just simply talked about kind of what was transpiring, the short term, the likely long term effects based on what you knew as it pertains to corporate earnings. What were some of those conversations like when you guys were back there in the trading desk area and you guys saw the big chart and the markets were starting to collapse? What were some of those conversations like?
Yeah, I think it was in the 80s. Was it Mike Tyson who used to say, everyone's got a plan until you get punched in the face? Yeah. So,
or get bitten in the ear?
Yeah, exactly. So I admit, I looked at that chart and I had no idea what in the world was going on. I was exasperated. if you walked back there, you'd probably hear a lot of words that you wouldn't repeat in public places. But it's one of the things that's great about the team now is we're expanded. So in the past, for the first, say, 5 years, it was James and myself. Now it's Charles and Dwayne and Chris. So there's a team of us that we can actually talk about and, our experiences or our thoughts and make adjustments. Charles is phenomenal about making in-race adjustments. He's a race car driver, and he's really good at adapting and saying, hey, what are we going to do now? That we're a little off course. The market's, done this. Let's hunker down and find the best names we can and go with those that we think are going to have the best returns from that point in time, as opposed to, looking at our portfolio and saying, well, I like this, it'll come back. A lot of times the down markets provide you opportunities to upgrade your portfolio. So we were able to do that.
Yeah, because most of the market, the way it was reacting at the time, Charles, it was throw the baby out with the bathwater. No matter how durable the stream of future cash flows for any particular company happened to be, it was going down. And if you were in certain sectors, you were hit harder than the others. So when you guys kind of took a step back there and made those decisions to say, okay, these are the companies that we have that are most exposed. These are the ones that are more part of the secular growth movement. Let's take the capital that we have, because in one of our trading strategies, we always keep capital and can make capital available pretty quickly to take advantage of opportunities. So you can eliminate some of the names that are less attractive in that environment, purchase some ones that are, and this goes back to the SMR, sales margins, return on invested capital, the fundamental approach to building portfolios, but then the top down, what's going on economically, what's going on from a fiscal policy, a monetary policy standpoint that can influence the capital allocation within the portfolios.
You just covered an enormous swath of
proper
capital markets and how to deal with it. A couple of things, right? So let's hit on a couple of things. One of the things that Chris said, for us, we can take a very unemotional approach to the markets. It's not emotionally driven. The words out of Chris's mouth, which company's earnings, cash flows were going to be impacted most adversely, or who would be best positioned. Those are the decisions we make. It's not any emotional attachment to any particular position. We're always trying to optimize the available capital. The other thing that you said, it's active management. And so, so you have to build these portfolios one stock at a time, but then you better take a step back and see what that top-down view, what's going on, what's changed with the world, and make those adjustments accordingly, and that's active management. The third thing you said, and we're going to come back and hit the other side of this, is when that event happened, it created what we refer to as systematic risk in the market. It impacted all stocks equally. The easiest way to envision that is that when the you-know-what hits the fan, all stocks act like one and behave the same.
All assets.
Right? Yeah. And so that then creates the opportunity where stocks who shouldn't be penalized as much are in that same basket, and their stocks get depressed terribly. And the guys then that have the capital and an approach that's not emotionally driven can come in and take advantage of that. And that's exactly what we did. Now that's different. I'll give a preview. We're going to talk about a little bit later in our conversations, or how style shifts can affect sectors differently, and how that impacts the market, and how the market may go down, but different groups of stocks go down at different rates for different reasons. But one of the things that we did and that we put in place was to also, you referenced a little bit, have a strategy that allows us, I don't want to say to take advantage of that situation so much, but it's to protect a lot of the downside when situations like that occur, and it worked out very well for us.
So style shifts you mentioned, which right now we're going through. We see this shift. In my opinion, in our opinion, it's most likely not long term. Right. And it's a shift from value, or from growth to value. And the interesting thing is, and I don't want to go too far down this rabbit hole, but our friends over at Dimensional, they would tell us that, and they're true, historically value outperforms growth. But for the past 15 years or so, growth has significantly outperformed value, but we're in one of those kind of quasi, let's call it temporary states to where there's a style shift where value stocks, I know, Chris, you don't like the term value stocks necessarily, but there are clearly names that are, defined and accepted as more value companies, and those that are, more widely accepted as growth companies. And we're in one of those style shifts right now. So I don't want to jump the gun too much because this is going to turn into the AI conversation. But I want to bring this back, and it's an interesting thought that I just had. I want you both to talk on it. Obviously, we've seen massive capital expenditure within the companies in the AI race. And make no mistake about it, we are in an AI race with some of the big names out there. The platforms, it's a huge race, and we're seeing billions and billions, hundreds of billions of dollars invested. But this year, we also saw the tariffs, which is kind of what we were talking about, which led to relocation of capital from companies and industries that were directly impacted potentially by those tariffs to technology companies that are not so much directly impacted. I know it's a question you can't possibly have an answer for, but how much of a catalyst do you think the tariffs were when it comes to accelerating the capital allocation to more AI stocks in the beginning of the year and possibly initiating some of the boom this year? I mean, we've seen massive growth in earnings and margins within these companies. It was likely to take place anyways. But do you think maybe that was a catalyst at the beginning of the year?
Probably didn't hurt. I mean, there was a lot of shifting where all these boxes for AI were being built because of tariffs, right? So instead of them being built in China, they're going to be built in Singapore or Malaysia and stuff like that. So, maybe there was some pull-in of ordering there, but I think the biggest event for the AI on the year was OpenAI and the amount of capital they were starting to raise at valuations that were kind of astronomical in the private market, and them going into the market and saying, we're going to take on Google, we're going to take on Microsoft, we're going to take on Meta, all at the same time and try to eat those businesses. And those are big companies with great cash flows who said, I like being, the top 1 or 2 in my business. I'm not going to let OpenAI do that, so I'm going to ramp my capex. So I think that was probably the biggest factor, at least in the last 6 months, in the AI race.
That, and you could throw in DeepSeek and how that changed things. But I'm going to take a little bit of a different tact than you did on Troy's question and position it this way. Where did capital flows go once tariffs were announced? And so many industries, sort of traditional, heavy, call it industrial companies, I'm thinking automakers, textiles and apparel, those folks' businesses could be impacted negatively as a result of tariffs. And one of our conversations, I described the world or the global capital markets is a dollar of investment always looking for a home, looking for the best place to be invested. And if I put a cloud of risk or uncertainty or some sort of impairment on certain sectors, then that capital flow goes to other sectors. And it may well have come into technology. So was that the driving force? No, but did
possibly
it help
an
at the
initial
margin?
catalyst?
You bet.
On a contributive basis. Quite
yeah,
possibly.
Yeah, sure.
So Fast Eddie, and we're going to get to this Fast Eddie, but he says the question I think that is on many of your minds: will the AI bubble pop in 2026? So Fast Eddie, you're going to have to stick around. I know you will. We are going to get to this in the second half of the show. We want to cover the impact of the tax cuts, though, because we had another kind of momentous occurrence this year, which is the passing of the One Big Beautiful Bill, which is going to impact corporate profits, and it's also going to impact you, the consumer. Some of those have already been baked in to corporate to calculations and stock prices. Some of those are yet to be determined. They take place next year, and the benefit is expected to occur next year. So tariffs, huge. So just to recap, we had the stick before the carrot. Quite the opposite of the first President Trump term, where it was taxes, 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 and then in year 2+, it was trade agreements and tariffs, et cetera. This year, it flipped on its head. So We passed the one big beautiful bill, Chris. AI kind of it seemed to me at least that AI was the overarching dynamic within the markets at that point. And it seems like we didn't get the same propulsion forward that we did in 2017 with the tax cuts. Thoughts?
Well, the tax rates are lower than they were in 2016. So incrementally, it's not as big of a deal. And back in 2016, 17, we didn't have this secular growth area of AI, the AI tsunami spending, which we have right now, which in the large cap tech world is kind of overshadowing a lot of the tax benefits early on, right? I think they're in a lot of the numbers for next year in the S&P 500 earnings progression. And then there certainly is a lot of talk about an uptick in consumer sentiment and spending coming towards tax day next year because the refunds will be substantially bigger in 2026. I think the average this year was $1,500, and they're talking maybe double as much because no tax on tips. And you can speak to the tax changes more than I can, but they're coming, and they're coming in 2026. They didn't hit the numbers in 2025. That was largely growth in the economy and earnings driven by the big tech guys.
But had that bill not been passed, corporate profitability would have been impaired substantially as a result of revision higher in tax rates, and your year-end target for the S&P 500 would have been materially lower.
It would have looked really bad. So yeah, year to date, people talk about, are we in a bubble? The stock market, I think, as of today, it's up around 15.5%, 16%. Earnings in the S&P 500 are up about the same amount. So we have had no PE expansion. Right now, earnings and valuations look nothing like in most areas of the market, in the big areas of the market, like they did in 1999 and 2000. Stocks back then were trading at 100 times earnings. There are a few companies, but they're not large parts of the S&P 500. Outside of maybe Tesla,
back up to like 180 for example.
You have a couple. Yeah. You have a couple, Tesla and Palantir. But outside of that, you don't have a lot of high PE stocks.
Because, see, I don't know when he said it, but I imagine it was somewhat recently because there's this whole robotics movement. It's been going on for some time, but it's becoming much more realistic. Right now, you can have a human robot you can have a robot that does tasks in your house for about $30,000. Obviously, they're not, perfect or anything like that. I wouldn't keep the kids around anytime soon.
I wonder where your dog went.
But
as
dishwasher.
I think Elon predicts, I believe it's around 10 billion humanoid robots by 2040. He said not too long ago, he believes that this segment of Tesla will end up accounting for, I believe, more than 80% of the future revenue.
That's because their cars aren't that good.
Did you intentionally say that lower? So it just kind of brings up an interesting point of kind of where the economy is going and how quickly AI is going to rapidly change the world around us. So any thoughts there as far as the tax bill, Charles, before I jump in with a couple ideas?
I think we're all in sync. I think that just as you said, a lot of it will actually show up in the numbers in the coming year. The only other thing I think we're going to keep tying something back to AI, everything we talk about in this
it's 2025 and rewind,
I guess. Yeah, but even, right, so the accelerated depreciation for capital expenditures is a beneficiary of all of the capital investment being made by the big hyperscalers for all this equipment that they're buying. So it's helped spur some of the rationale behind, how this money is being spent.
Which gets into a whole nother area, which is hotly debated as far as the let's call it shelf life of some of this material and how quickly it's being depreciated, which has a direct impact on earnings. So that's probably too deep of a conversation for a live stream, but the circular financing is a hot topic, and then the depreciation schedules of a lot of the assets of these tech companies. So when you depreciate something, you reduce its value, which offsets which increases your expenses, which influences your earnings. So there's some concern there.
Well, I would tell you that the expected useful life of a lot of this equipment is determined by the auditors. It doesn't mean that it's right or wrong, but it means that it's practiced in a uniform manner across all the companies. And a lot of times, you know, people say, well, this is really bad. And we'll say, well, no, it's not that bad because it's going to happen to all the companies in the industry. So it's equally bad for everybody. So it's not as impactful in a negative way as you might think. But anyways, right, so that's determined by the bean counters. Now, this idea of circular financing, that's another issue. That could potentially be problematic, right? We don't give our clients money to give to Oak Harvest to invest on their behalf to collect a fee on.
Yeah.
And that's sort of the scenario that some of these companies are engaging in.
You want to explain it a
business.
bit further, Chris?
No, I was just going to say, but even with the accelerated depreciation, I mean, the markets are very smart, right? We've seen the big tech companies that are spending beyond their normal cash flow, whether I think Meta went out and borrowed $35 billion, and Oracle obviously has gone out and borrowed a lot of money. You know, their earnings trajectory is still going up rapidly, but the market jumped to really quickly. These people are spending a lot more cash than they have historically, and they hit the stocks pretty dramatically, even though if you look at the earnings progression over the next year or 2 years, it's actually an acceleration in earnings, but the market is saying, hey, this money's going out the door right now. We can't be patient enough to look out a year or two. We're going to sell the stock and wait and see what those returns look like. So the market acts a lot faster than it used to run to probably the worst case scenario or the best case scenario.
So one of the big risks, and again, not to kind of jump ahead here, but one of the big risks is it's the third component that we talk about all the time, the return on invested capital. So you have these big companies, and I'm going to use Meta as a primary example here, because not only are they using their massive amounts of free cash flow to invest without really any clear direction of what they're doing in the AI space,
right,
after some complete failures as far as rollouts recently, the stock really hasn't been punished that much, but they're using free cash flow, they're borrowing money, they're going into the debt markets. Not to say that it won't work out. Mark Zuckerberg, clearly a very, very capable person, but there is risk not only for Meta, but for many other companies out there that are making these massive deployments of capital, and they will ultimately be measured, and the stock will as well, based on the return of that capital that's deployed. And that's the third metric of what we use here to determine the companies that we invest in or not. Sales, margins, return on invested capital.
Agreed. And, you know, although you could point to the fact that they're only using 40-50% of their free cash flow for this incremental investment, you still don't have a line of sight of what the return of it is, the return on that capital is. And that's capital that could be paid in a dividend or share repurchases or investment in other areas. So yeah, it creates a degree of uncertainty.
And the market's actually been very good at differentiating kind of the winners and losers short-term year to date in the Mag 7. There's 7 Mag 7 stocks. Only 2 have outperformed the S&P 500 year to date. Google, and that's because recently, and then NVIDIA. Yeah. The other 5 have actually underperformed the S&P 500 because they're either spending more money than people want them to, or their business is slowing otherwise.
One of the interesting things here, and I have to bring this up, is we're seeing a complete shift of business model from some of these huge companies. You know, Google, for example, shifting from a company that's had most of the revenue from search and primarily from search to now launching products within the AI landscape and shifting their business model. It really reminds me, and especially you guys, of some of the business decisions that were or were not made, you know, back in the late 90s. Blockbuster comes to mind, right? They had more than one opportunity to purchase Netflix, and they didn't make the right business decision. So these companies, trillion-dollar companies, taking huge risks with hundreds of billions of dollars, completely changing the direction of their company. That's one of the big themes, I think, of 2025.
Yeah, and I think we need to pay attention to that and say that this is, you know, either you're in it to win it, and they have fortunately for themselves put themselves in a position where they have the capital to do it. Yep. And so they're going for it.
It's going to be exciting next couple of years.
It will be, for sure.
Much.
Okay, so we are going to do our first raffle now. So if you have not registered, I think, Corinne, they have a couple minutes to register for the first raffle. So you should see a QR code on your screen. You have an opportunity to register. We're going to, you will receive a guide from us, but the raffle is for an opportunity to win a $100 gift card to your favorite restaurant. Corinne, what's the guide that we're giving out tonight? Oh, the weekly market update. So you'll not receive a guide. Sorry about that. You'll actually you will sign up to be a part of Chris's weekly market update that he puts out weekly. I know many of you may already be subscribed to that, but go ahead and register for the raffle anyways. We're going to do that in the first one in just a couple of minutes, and then we'll do a second one towards the end of tonight's show. So, guys, let me just check in to see if we have any comments here that we can discuss. I saw, I guess it was just, so, okay, so it's always hard to pronounce the YouTube names, so I'm sure I butcher these all the time. Shosansa? I think she was talking to someone else in the chat here, so shortage will be on cell phone DRAM, not HBM memory for AI servers. Mean anything to you guys?
Yeah, it does. Oh, just there's been talk, I guess, in the market about there being shortage of DRAM capacity, largely in a high bandwidth area, which is AI related. Micron has decided to get out of the consumer area, so there's concern that cell phone pricing next year will go up. If you buy a, Apple 17 or the new foldable that's supposed to come out next year, pricing might be up 5 to 7%. It's possible. I mean, is it going to hurt demand if they come out with a foldable at $2,000? I don't think so. Everyone I know who's under 35
where those refunds. Guess where those no tax on
exactly.
refunds are going.
So, but it has certainly been a benefit to Micron. I think year to date, Micron's one of the best performing tech stocks, as it tends to be in semiconductor cycles early on. They have some capacity and everyone wants it, and they're sold out this year and next year. So, semiconductor industry, very interesting. A lot of people have been talking negatively kind of about it because NVIDIA's stock has gone down since they reported. Been doing this for 35 years, and I've never seen a semiconductor cycle peak 9 months after it started, right? If this started probably back in April, we're only 9 months into it, and our companies haven't even started ordering equipment. So a lot of the Chinese companies have started ordering semiconductor equipment, but U.S. companies have not. So probably a good runway next year for most semiconductor companies out there.
Agreed.
So you said something, Chris, before we kind of move on to the next topic, but this ties in really well again to a lot of what we talk about fundamentally. But you talked about the impact of the tax cuts. And I just wanted to clarify that, but then also take that comment and apply it to a lot of the decision making that we apply to stock selection. So it was the incremental impact of the tax cuts being extended on retail, on consumers as well as corporate profits. Right now is much smaller than the incremental impact that it had back when we went from 2016 rates to 2017 rates. So it's a very astute observation. And Charles, I'm just going to throw it to you because really what we're talking about here in reverse kind of is margin expansion, or at least the marginal impact of corporate decisions. In this case, it's a governmental decision that impacts corporate profits, but it's the margin. It's what impact is this factor having marginally on earnings, cash flow, consumer spending, whatever it might be.
Yeah, I'm not quite sure what you're trying to get at.
Well, so let's just to put some clear numbers on it to make it easy for everyone to understand. Let's say tax rates were at 35% and then they got reduced to 20. Yeah. It's a 15% marginal reduction. Now we're already at 20. Now they just stayed at 20, so there's not much of a marginal impact.
Right.
But now if a company is, let's say, bring it back to the stock price to get to my bigger point, let's say a company now is launching a new service, okay? And that impact is gonna, without much expense, drastically increase revenues and therefore profits. That decision has a much more marginally a great impact
Yeah,
on cash flows and profitability, and then you see the acceleration of the stock price because of something like
Oh,
that.
sure. Yeah, right. Well, think about it in this way. Stock prices and capital markets in general are always looking at where change is occurring and where that change is occurring at the margin. Is it getting better? Is it getting worse? And so any instance like that where you're just incrementally improving profitability, then the model is such that you pump a little bit more revenues through it and you generate a lot more profits and cash flows out the bottom end. And, the market rewards those types of companies. So,
Yeah, I just kind of saw the tie in there
Yeah.
from economically what was
Yeah,
happening to kind
yeah.
of what we do on one of the things when we're looking for.
Oh, sure. Yeah. Well, one of the first things I always look at is incremental operating profitability of a company when they report, right? So for each additional dollar of revenue, how much dollar of operating margin or profit margin did they generate? And if that relationship is positive, that's beautiful. Check.
And tying this back to AI, the golden ticket of AI is conceptually productivity gains over the next 5 to 10 years. And we're going to talk about productivity gains from a stock market perspective, not from a labor perspective with regards to people trying to find jobs, because most likely AI will move job creation around, right? It's already slowing job creation in the engineering and computer engineering and software world, because a lot of tasks that new entrants into the job field were doing are now done by AI,
Yeah,
right?
I coded something recently. I did.
No, I know. I know. So
That's impressive.
And I know a lot of engineers getting out of college. They're searching for jobs. They're struggling. I hate that, right? I was an engineer trying to find a job in 1988, right after the stock market crash in October. But from an investor's perspective, the late 90s, the dot-com boom was largely a productivity boom because we put all that fiber out there and companies like Amazon were built. Companies like Netflix were built. And they used all that capacity and generated lots of productivity from that overcapacity eventually and created these new businesses. So, in the short term, we may not like these layoffs that are being announced at some of these tech companies from a social perspective, but from a investor perspective, if lower employees, higher revenue, higher margins, higher productivity, higher cash flows, higher stock prices. So, it's a tough balancing act to separate your investing decisions versus your social decisions. But, our job here is to try to maximize your returns for your risk. And so if we see productivity enhancements coming from AI and it's because of job layoffs, you might see some stocks in your portfolio that companies are laying people off and the stocks are going up and you're asking why.
Yeah.
Why is because there's more money for the shareholder.
Yeah.
So,
Okay, so we have the winner to our first raffle, and it is Jerry Wolf. So, Jerry, congratulations. You are the winner of tonight's first raffle. So our marketing team will be in contact with you to deliver your gift card, $100 to your favorite restaurant. Just as a reminder, we have one more raffle that'll be coming up in about 20 minutes, but you can register for that now by scanning the QR code on your screen, signing up for our weekly market updates, and we'll do that next raffle for another $100 gift card to your favorite restaurant in about 20 minutes. So just important, I think, to point out there is, at least for my belief, and I think a lot of people agree with me, the most productivity gains will be when human partners with AI. So it's not, there will be dislocation, there will be job loss, absolutely, there will be jobs created, but from a productivity standpoint, especially right now with where we're at, and there will be exponential gains in compute power and in other aspects of AI that will occur over the coming years. But for me, AI is not replacing anyone. I shouldn't say anyone, but it's not replacing what I do anytime soon. Okay.
So replacing what I do, Troy? No. Just let me know later. No.
But point being is, though, when I utilize it, though, I become far more productive. Literally probably 10 times more productive. Yeah. Just today, I got more done today than in years past I maybe would have got done in 10 days, 12 days.
I'm going to sound
15.
super old. It's Excel for, 2025. I mean, it really is.
No, it does make sense.
I mean,
Going from
it's-
pad and paper to Excel.
Exactly.
And
On
what's
steroids.
interesting and what you've described is not anything that hasn't happened previously. I mean, you go way back to
this
the
magnitude,
Industrial
though, Charles.
Revolution.
Maybe.
Yeah.
Yeah, good
and,
point,
And,
though.
and the same things occurred. What's different is the rate of adoption of this particular thing and how it is being adopted first and foremost within the enterprise, right? Because previously things like, do you think horses versus cars, right? It took a long time, and then it was all,
Which is shocking,
people,
by the way.
Yeah, right. And then you go back, but you look at other things, like, any of these technological advancements. I think of a lot of Apple's products, right? The idea of a mobile phone. You didn't know you really needed a mobile phone, but something that was basically a mobile computer, and that was primarily a consumer item for the long time, and so was iPads and the like, and so were Macs and such. But then it was the commercial or the enterprise adoption of it that led to the exponential growth in the company. What's different this time is that a lot of that adoption already is in the consumer's hands, and it's really migrating up through enterprises currently, and so it's driving at a much accelerated pace that's leading to accelerated productivity.
Yeah, and you have. I've said this for a while now. The labor market will be divided in the coming years by those who are comfortable in using AI and those who are not. Those who are not able to partner with it in order to enhance their productivity at the benefit of their company or their whatever they're trying to accomplish will be left behind by those who do.
And it'll create entirely new livelihoods for people who are creative that understand how to use those tools, and we'll figure out a way to develop products that people didn't even know they needed.
I was listening to a podcast today on the way into work, and they were talking about the soon-to-be need to reskill entire bases of employees. So if a company wants to lay off 10,000 people, they'll lay them off, of course, because it's a financial decision. But believe it or not, a lot of people still care about the people that they're laying off. But it's a decision that has to be made.
Right.
So an industry that is soon to be in existence that you all will probably start to hear about will be the reskilling of employees to where, okay, we're going to lay you off, but we're going to give you this education, this training to reskill you to re-enter the workforce and give you this opportunity in this new economy.
If you've recently been laid off and need a job, move out to Arizona and go into the training program that will provide the training to the workers that'll go into the TSMC semiconductor fabs that are being built there as a part of just this
Same concept.
same thing.
And so that's the thing about capital markets, though, just in general, and capitalism is, there is disruption, there's dislocation, but there's opportunity. There's never been dislocation and disruption that I can think of in this world that doesn't also come with opportunity for those that are willing to pursue it.
Agreed. Yeah.
So, we've talked a lot about AI. So if there are any particular questions specifically about the AI boom, what's transpired here in 2025, wait, Paul's here. Hey, Paul, I must have missed you a little bit. No, looks like it just came in. So Paul Fogel says hello to you guys.
Awesome.
He says the S&P has a high PE ratio today versus long-term average. Do you see the index overall becoming better valued with the efficiency of AI? So really a two-part question. And Paul, I mean, I'll leave it to you guys, but I would assume if the PE ratio on the S&P is higher than historical averages, it can't be by much, I would assume. Maybe marginally?
It's only by what we refer to as a couple of turns. So if it previously was a 20 PE, now it's 22 or so. So it's nothing incredibly higher.
But interest rates are lower.
Right, and that's an impact. But think about it this way: the most highly valued companies are those that have improving sales margins and this return on invested capital. It's particularly this return on invested capital, right? Investors are willing to pay more for companies that provide a higher return on the capital in which they've invested.
The core of the Oak Harvest investment philosophy.
Right, and it's capital markets in general. It's not like it's something just completely, copyright, patented Oak Harvest investments, And in keeping that in mind, you've got now a fairly large concentration of companies, these incredibly large companies that generate tremendous amount of revenues that are in the S&P 500. What's the common attribute about them? They all generate substantially higher return on invested capital than the other 493 companies. So therefore, it only makes sense that there would be some uplift in the overall PE of the market. That doesn't mean that it's out of whack. It just means that the nature of the earning stream that's being generated is of a higher quality, and thus wouldn't you pay a slightly higher price for that?
More durable.
Absolutely.
So we talked about this yesterday, Chris. Cisco was the example that we kind of brought up. So back credit to Cisco because they're still around when most of the companies in the dot-com bubble are gone. But you look at the price of the stock back then and the actual earnings, and pick any dot-com company, you compare that to kind of what's transpiring today with these massive spikes in price and where earnings of those companies actually are today, you see night and day story.
Yeah, I think Cisco back then traded at 100 times earnings, 100 times calendarized earnings. NVIDIA, I think, is 24, 25 times calendarized earnings right now. So, dramatically different. And I don't know what the right PE is on NVIDIA. No one obviously knew what the right PE was on Cisco back then. I went through it. I was out in San Francisco while all that was going on, and maybe 100 times earnings was the right number for Cisco because they had no marketing. They didn't have to spend $1 on marketing. People were literally calling them up saying, I'll take,
8,000 routers.
Yeah, exactly. So, they were order takers. They weren't salesmen. And I guess you could argue that some of that's going on with NVIDIA currently and some of the other semiconductor companies. But I don't know what the right PE is. I just know that, currently the fundamentals of NVIDIA and semiconductors are strong. Mm-hmm. They seem to be not weakening. This is a seasonally weak time for semiconductors from an order standpoint. Usually, we're not hearing that at all. Fast Eddie asked about comparisons to .com. I mean, I would send him back to some of the videos we've done the last couple months. If this is a bubble, and you compare it to .com, we're not even close to the end. I mean, you're at a part where you still want to be invested in the investment in AI because the .com capex spend lasted another 12 to 15 months from this point in time before the stocks kind of said, we've had enough, everyone's over-investing, we're going to run away to everything else. So
there was a rapid kind of divergence from the stock prices and the actual earnings. You had, Cisco is one company we bring up trading at 100 times earnings, but I'm sure there were many other companies out there with no earnings, right?
Yeah,
Negative earnings, trading at a lot more than from a valuation standpoint than Cisco.
So two things to address Fast Eddie specifically, right? Is it a bubble? You don't know. You're never able to define if it is or isn't until after the fact, right? So it's always It's always sort of a backward-looking thing.
True, but if I were to define it, I would think of a bubble as this massive expansion of a price multiple above earnings per share. So to your point, 100 times with very little earnings.
Right.
When you look at NVIDIA, where we have this massive price spike, for example, but only 20, 25 times earnings, how could that, and this is just my opinion, how could we ever define that as a bubble? Now, it doesn't mean that NVIDIA couldn't drop 50% tomorrow.
Right.
And let's make that difference.
And here's what I do, right? Call it old school, and he does the same thing. You go back and you say, what's the PEG ratio, right? What's the PE to growth rate? So if the PE on the NVIDIA is let's say it's 25, just to throw out a number, the next full year forward's growth rate in earnings is projected to be 45 or 50%, right? So it's still selling at a PE, which is at a discount to its next year forward growth rate. And to me, that's my, lift the finger and stick it in the air sort of, smell test on what's going on. What's kind of interesting to me is that it, more than any other time, it appears as though these orders and these order rates appear to be durable, right? The problem would be somebody calls up and says, nah, sorry, never mind, and these order rates aren't firm, they drop out of backlog, then we have a problem. You go switch back to what was a bubble back in 1999, right? We were talking about it the other day on the radio show, right? We were in such I guess it was a privileged position to be in, where we were one of the funds that we ran were one of the primary investors as a growth investor in IPOs. And we were a huge firm growing. Every company who was doing an IPO would come through to our offices. We would literally show up in the morning and have a cup of coffee and start the meetings. And there would be a line of limos. You could see them out my window in my office lined up, the investment bankers trotting in the managements, pitching the next deal. And all of them were interesting. Some of them were absolutely absurd in terms of the business model.
Or you guys were managing there 20, 25 billion?
28, well, $32 billion in total. The interesting thing was, and so what I would use to not sound like a jerk, but to validate our views and what we did, is we actually ran a product there, just as we do now here at Oak Harvest, that we could also express a negative view on a company. And so once it reached a point of lunacy, right? I mean, look, I remember going home at night being short the equivalent of $500 million of Amazon.com, right? And that's a fairly nerve-wracking position to be in, but you had to be in a position to understand kind of what was going on, the game that the street was playing. And at a point when Cisco, going back to them, is trading at 100 times earnings, how much incremental revenue do you have to put on top of that to begin to justify that sort of price?
And because on the margins, it's at some point it's going to tip over, and marginally once things start to decline, that's when the stock price tends to.
Yeah, and so a lot of these companies, what came about, the good thing that came about of that was the development of a lot of companies which were platform companies. Companies like an Amazon is a beautiful example. They weren't just right. They started off selling books, but what they really did was they spent a boatload of money, almost to bankruptcy, to put in place a platform that allowed them to layer in then multiple businesses to then begin to generate that return, those margins, and the return on that invested capital.
I bet most people don't remember or realize that Amazon didn't turn its first profit till maybe 6-7 years ago or so.
Yeah,
it seems like
it was such a good story that the street gave them a hall pass to continue raising capital with the intended purpose of at some point slowing down that capital investment and generating massive cash flow. That's why the street now is probably more willing than they would have been before to say, hey, these guys understand capital allocation. They know they're good managers and good custodians of my capital, and I'm willing to endure some of this spending, knowing that the payoff is coming later.
And Chris, I know you got something to say, but I just wanted to just that's such an interesting dynamic as far as the relationships between the people on Wall Street today in senior positions. They were like you guys, back in, mid 90s, they were, call it earlier on in their career. But you guys have, 25, 30 years of experience of seeing this through multiple market cycles, and you understand the game, you understand the players in the game, and that I think gives you guys an advantage when it comes to being able to layer on what you've learned over the years to an advantage relative to the decisions that you can make today.
I think so. Gosh, I hope so.
Yeah.
Don't we all?
Yeah, I'm counting on it. I'm counting on it and willing to eat my own cooking.
I know you used to tell me the stories of, or a couple times we talked about sitting in those meetings that Charles is talking about with Bezos from Amazon coming in and giving his pitch. Interesting, I guess, interesting
Yeah,
companies
yeah.
you guys definitely sat with over the years.
It was a privileged position to sit in and be able to just the view of the world and how things were evolving. It really was.
And there are cases of speculation and business models that don't really make a lot of sense right now, but it doesn't seem to be anywhere near the excess that it got to during .com, because as Charles said, a lot of these companies are larger, more established companies that are spending this money. So there's, the question is it an AI bubble? Well, are you talking about a stock bubble or a capex bubble, right? Because right now it doesn't, valuation-wise, revenue-wise, cash flow-wise, it doesn't look like a stock bubble.
So one thing, I'm sorry.
No, that's it.
Yeah. So just to piggyback upon that a little bit, right? Back in 1999, these companies that were coming out and they were being supported and they were being funded by the venture capital community, and then later guys like us that ran mutual funds that invested in these IPOs and gave them additional capital. But then they would turn that around and spend that capital immediately on bandwidth. We need bandwidth. And that's where the overdevelopment came and overexpansion came. What we're doing now, today, in our portfolios at Oak Harvest is we have literally shied away from those folks who are spending all of that capital and positioned ourselves more directly, I like to say, in the way of where all that spending is going. And so, yeah, we own some Amazon, and other names, but we own a lot more of companies who provide the infrastructure into all those data centers that they're building.
I love the way on the radio show that you talked about this recently, because it comes back, and this is apparently the theme of tonight, is the marginal return on those dollars. So when you have this stock price acceleration and you have good earnings report after good earnings report, at some point, marginally, the risk is, that starts to decline. Mm-hmm. It starts to tip over. And you could still be at 65% profit margins and sales growth at 60, 70%.
Right.
But if that's 5, 10% below where you were last quarter, the stock's going to drop 10, 15, 20%.
Yeah.
So to that's, I like that. But I also don't want to overlook something you said, which was really important. It's okay. We see, and I feel this is comfortable to say, we can't give individualized investment advice here, and talking more from an educational standpoint, but we believe right now, I guess let's couch that by saying educationally or from an academic standpoint, that there may be less risk with companies that are receiving these hundreds of billions of dollars and aren't making these large expenditures, taking on massive amounts of risk. Right. When they're just making the deposits,
where would you rather be? Would you rather be the company who are making these big bets, taking on debt, spending a bunch of money, or the guy on the receiving end that's having to operate a second shift, a third shift to make lasers, for our networking equipment, right?
Yeah.
You'd rather be that guy. And that's where we've shifted our emphasis. But here's the rub, and here's where the frustration comes.
Shift, right?
Right? Nobody cares right now, right? Nobody cares right now because they say it's AI related, and today I don't want that. Boom, out the door. It gets sold.
But that's where having a longer term focus and believing in quality over the next greatest thing and maintaining that long term approach, we believe is going to we believe is a better approach to
it wins over time. Yep. Yeah, we know it does, and you just have to stick with it. And that's the one thing I try and emphasize from my perspective is we say what you do what you say, stick with it, and try and do it well. and tell people what it is. These conversations like this, hopefully people listen to it and they get an understanding. If they see, what's going on with the returns, they have a better understanding of what's going on, knowing that the payoff is coming, we believe.
Well, we have a kind of a theme around here as far as in the office. Put your head down.
Stay focused and put up the numbers.
Put up the numbers.
Everything else
The
will
rest
take care of itself. Yep.
That's Charles has been saying that for 35 years.
Yeah.
So yeah, I'll go with that. So.
Yeah.
Okay, so we have the second winner of tonight's raffle, and forgive me if I mispronounce this or if I say it incorrectly, but I'm going to go with La Suter, L.A. Suter, so Seutter. I don't know if that's a handle or a name. I assume that's a name because we registered for the raffle. So, well, congratulations. You are the winner of tonight's second raffle, and that means you are going to receive a $100 gift card to your favorite restaurant. Our marketing department will be in contact with you. So thank you very much for tuning in. Thanks for signing up for the weekly stock market update, and congratulations. Okay, guys, we're at 7 o'clock here. We honestly do not have as many questions as I was expecting in this kind of chat about AI. I think it just means that it's such an enthralling conversation that people are just listening and absorbing all this knowledge that we're sharing.
Yeah.
I've found after working for you for 8 years, Troy, it probably means the market's up and people aren't really concerned that much about their stock portfolios because they've had a decent year if they're in the S&P 500 or most indexes.
But you also know that fear tends to creep in
when things are down.
Yeah, well, that's true too. Yeah, because so we have a saying kind of in the retail industry, and by that I mean working with individual clients. Whenever we get the clients that typically call in that are scared of the market and they say, Troy, I want to invest. Could you open up an account? Or, and I want to increase more money into my account. That's typically the sign that everything's about to tank. So,
Yeah, it's just the other interesting thing where we said is an interesting observation point for human behavior, particularly as it relates to their finances. But at the end of the day, for us, that's a good thing because we're the solution to that, and people call, and I'm as the investment guy, I'm always impressed. I love to sit in some of the meetings with advisors and hear how they talk to the clients and the level of sophistication of what they do and the process and all. It resonates with me, and I learn something every time I sit in one of the meetings with any of our advisors.
It's just the different components of the retirement planning process. You guys, obviously, we've compartmentalized the investment decisions, and this is something that's unique if you don't know about Oak Harvest. At a lot of firms, the advisors are the ones that are doing the advisory relationship. They're doing the marketing for their independent firm. They're doing the servicing. They're doing the investing. They're doing the research, the analysis. They wear so many different hats. We've compartmentalized all that here at Oak Harvest. So that's your guys' responsibility. That's your job. Build the portfolios, manage the investments. Our advisors, they're planners. They are educated. They are trained. They are experienced in the tax planning, the income planning, estate planning, healthcare planning, long-term care planning, risk management, allocated the portfolios across the tools based on your team's experience and expertise. So one of the unique things about Oak Harvest that I don't think maybe we do a good enough job marketing or maybe explaining to people because it is unique in the industry, and that's a huge. It's the way. It's the way I built the firm. It was my vision from the beginning of what is best for the consumer.
To me, it makes so much sense because if one person is trying to do all that, they can't do it well. They can't do all of it well. They can do it mediocre at best. But if you compartmentalize it like that and give each group their charge of what it is they need to do, then hopefully they can do it at an exceptional level.
So we have one. Maybe it's a comment over here. I just want to provide some insight. So, Paul, I believe it was you that was discussing using AI every single day, and I do see another question you input here. I'll get to. Maybe it was Fast Eddie. No, Fast Eddie. So it's around the accuracy of AI, and I read something recently on the hallucination rate of these language models. So
Yeah.
I'll leave it at that for you. I encourage you to kind of Google it. There is still a ton of misinformation being provided by ChatGPT, by Claude, by Gemini, by all of these platforms. Do not, by any means, take whatever answer that you put in there with a grain of salt and just assume it to be true. I'm preparing a YouTube video that I'm going to do pretty soon. And I pretty much come to the conclusion that I'm just going to do a live YouTube video for you guys and show you this so you don't think it's been doctored or kind of prepared in advance. I've ran it a few times, and I create a case scenario where I just simply, husband and wife, I have this much in assets, this is my Social Security, all my retirement planning variables. And I say, build me a retirement plan. And the reason I came up with this was because I have a buddy of mine who was like, Troy, yeah, I just went on there and just built me a retirement plan. And he was just thrilled with it. And I was like, well, buddy, I was like, maybe you want to let me see that. And, no. So I said, okay, let me see what possibly could have went right here or went wrong. So anyways, what the ultimate deduction is, without having to wait for the YouTube video to come out, is there is a lack of critical thinking available.
Yeah.
It goes down a path and it sounds really good. And in the beginning, I was like, man, this actually isn't too bad. But then when it got to the critical thinking aspects, it's way off. It's not even close.
Yeah, well, I mean, these large language models, which are the foundational models of generative AI, they're just looking at relationships between words and putting together patterns and sequences. And so what it lacks is just, as you said, this critical thinking element. And it's getting better, but you just at the end of the day, from the investment team standpoint, we have always used technology. We have big proponents of technology, and one of our team members, Dwayne Botchak, is just absolute brilliant in terms of his skill set and how we use it. But it's a tool, right? It's not the answer.
It'll never replace.
It's a tool.
The way it's so rapidly developing, it's hard to say it'll never ever replace.
Right.
But
never say never. But
my foundational belief, there's no reason to be afraid of AI, at least from a skill perspective, because the ultimate, I think, product will be delivered by human and machine partnering together. Because I'm not an expert in AI, but I just right now, technology as it is in its current form, it's not capable of doing what a human being is able to do.
Right. Right.
Yeah. Okay, so guys, so one more question here, and we'll wrap it up. So Paul says, I'll ask a question about how much tax will be owed on a specified amount of money. Oh, he's talking about GPT. Paul, I do not trust GPT on that. Send it in to us. I wouldn't mind contrasting it against a real tax software. So Paul says he sends it in, breaks down the calculation to arrive at the answer. Maybe if it's a basic tax calculation, when you start to get to layers of the tax code where, for example, how does certain IRA distributions maybe impacts the amount of Social Security that is now brought into a state of taxation. For example, we have 7 or 8 different definitions of modified adjusted gross income within the tax code. Highly doubt any language model is able to decipher the different modified adjusted gross incomes and understand which ones to apply them to, because that's a critical thinking skill. It can scour the internet and it can find articles that will have those words in it, and then take that information, check that against everything that it's learned previously and maybe put it in. But from what I've seen, and I've went through this because, as I said, I'm going to be doing this YouTube video, it's nowhere close to being able to do some of these more advanced tax calculations and planning. So Paul, send it in. I believe Nicole could get that. We'll check it out. If it's something simple like, hey, if I make this much money, what does the tax do? I'm sure it can accomplish that. If it's more critical as far as the reasoning and thinking requirements, I'm highly skeptical at this point, but love for it to check it out. Any final thoughts, guys?
I'm just thinking, what would the IRS say if you came back, you know, on an audit or something like that? But
Use
ChatGPT
ChatGPT.
told me to do that was the right answer, and I'm thinking the IRS was going to say, "So sorry."
No, they're not going to accept that.
I was thinking. I said this the last time we did it this time of year. It's like, it feels as though maybe ICE is going to start shooting at Santa Claus when he comes across the border. It's kind of felt like that lately a little bit, but that hopefully the old guy makes it through and brings us some nice gifts for Christmas.
I'm going to leave it with a shameless plug. We started releasing our first half 2026 outlook last week in video. The second episode comes out this Friday, and we're going to do our live stream on January 29th for 2026, the first half, Charles, myself, and Troy. So hopefully anyone viewing this will tune in and get some other people on that.
Yeah, so really good point. Thank you, Chris. So tonight was all about going back, looking at 2025, some of the major themes, what has transpired. Really, though, it's kind of a two-part because we're going to do the 2026 outlook on YouTube here, January 29th.
Yep.
Yeah.
So what we wanted to do here was create the kind of the foundational knowledge and set the stage for how we got to this point, and then really dive deep on January 29th into what are some of the major themes of the year, which direction could things possibly go, and as always, and most importantly, what it means for you and your retirement. So guys, I want to thank you, of course, very, very much for tonight.
Yeah.
I think this was very, very, for me at least, interesting conversation. I think we provided a lot of value here. And you guys, thank you very much for tuning in. We look forward to seeing you soon. And January 29th, put it on your calendars. We will be diving into the 2026 stock market outlook, Charles, Chris, and myself. Have a good night.
Thanks.